Hello and welcome to Simplify Your Retirement with Stephen Strickland from Wise Wealth. Hello, Stephen.
Hey, Paul. How's it going?
Very well. I'm excited for today. Today's going to be a fun episode. You know, we have this season is all about having different guests on and different experts, different industries, different things that may impact your retirement planning. And so I'm excited for today for a couple reasons. The first is this is a really exciting topic because, you know, we have our principles of financial planning, and one of them is no investment decision outside the context of the plan, and a plan determines the product. Right? But the question is, what if the product doesn't exist that you need?
Right.
And so that's where today comes in, because there was a need discovered and a product created for that need.
Absolutely.
And many people don't even know about it. So we want to make sure that our listening audience knows about this product, especially the need it fits.
Yeah.
But I'm also excited because when I got started back in the industry back about 20 years ago, I was working for an insurance company, and one of the guys that I heard about a lot and kind of saw around, you know, he's like this rock star guy that you just, you know, this personality, right? He filled the room. But I knew of him back then, but I hadn't had much interaction with him. And now, here 20 years later, our paths are crossing again in a different capacity.
Right.
But it's exciting to have him in the studio here with us today. We have Phil Graham in the studio with us today. And this is exciting because he has a lot of experience in the industry. And so from an industry standard, you know, he's well known. The average client wouldn't know who he is. But what's exciting about it is because he's connected to so many people like us who meet with the clients day in and day out, he hears more and more stories than we could ever hear in our lifetime. And he's able to identify problems and then try to solve them. And that's exactly what he's done.
Absolutely. Yeah, Phil, it's great to have you here on the podcast.
Thank you, gentlemen.
Appreciate you being here, coming all the way in from North Carolina.
That's right. Short flight into Kansas City.
All right, great. Thanks for joining us live here in the studio. So, as Paul mentioned, you know, obviously our value proposition for everyone who watches the podcast is to provide education. That's one of the main things that we do to bring to our clients or our listening audience maybe people, maybe products that they've never heard of. And a lot of times we introduce, you know, different, you know, products potentially that people may or may not need, they may or may not need now. We always want to make sure we expose them to it instead of somebody else so they get all the information they need on it. And so that's what we're excited about today. Like as Paul mentioned, you know, there's a product that we're going to talk about with you that we think is extremely important for our clients to hear about, but everyone who listens to this podcast hear about it too, because they may not be aware of it. And so I think that's important. Like Paul said, the plan determines the product. So we always start with, hey, make sure you have a plan first and then find out where the products fit inside that plan. But obviously, Phil, like Paul said, you've been around the industry. There's not a product that you're not aware of. And so for you to basically innovate and actually invent a new product in this industry says something that you saw something that was not out there. And so it's called the Beneficiary Liquidity Plan. So you want to just start by just telling us about that, and you know, what was it that made you see that this was a need that's out there?
Yeah, thank you. And Paul kind of hit it where he's like, you know, I've seen tens of thousands of client situations working with top financial advisors like you guys across the country for 25 years. And we'd focused a lot on the retirement market. Well, the retirees we were working with in the late 90s, early 2000s were starting to pass away. And so we were seeing claims, and we, you know, being kind of in the middle between all the insurance carriers and the financial advisor offices, we were assisting in some of those claims processes. And I realized people needed money. The beneficiaries were calling going, you know, hey, Stephen, mom just passed away. And what we normally said was, oh my gosh, I'm so sorry for your loss. We loved your mom. She was a great client. But the beneficiaries almost immediately were going, well, you were mom's financial advisor. You helped manage the money. We need money to pay for the funeral. I got to fly my sister in from California. We want to take a family trip, you know, to the Ozarks and spread mom's ashes. And we want to have a celebration of life. The tax bill's due. I got to pay the mortgage. all these expenses were happening, and there was money there,
Right.
but they couldn't get to it immediately.
Yes.
It took weeks, if not months, to kind of settle the estate properly, get the death certificates, file the claims. So what we saw the need was, well, how do we create some kind of immediate liquidity for the beneficiaries without having to buy something extra?
Okay.
That was the key.
Okay.
Was if you're already leaving an inheritance, how do we solve the problem?
Right.
But let's kind of dive deeper into the problem, I think.
Yep.
It was interesting. We've been doing this 6 years now. And when we first started and I was working with financial advisors, they said, well, my clients have a lot of money. They don't need this, Phil. I said, actually, quite the contrary. The more money you have, the longer it takes to settle the estate and unwind everything properly. Here's an example. Prince.
Right.
The musician, formerly known as Prince, literally formerly known as Prince, died April 21st, 2016 with debatable, well over $100 million, could be $300 million, depending on who you ask, estate.
Right.
It's pretty big.
Yeah.
And I love asking this question, if you already know the answer, but who paid for Prince's funeral? And I love asking people this, because they go, well, his family. I'm like, no, they were waiting for him to die. They didn't have any money. His agent. No, it wasn't his agent. It was not the state of Minnesota where he's born and raised.
That was my guess.
It was the family friend, actor and comedian George Lopez gave Prince's family $20,000 to bury him because they couldn't get to any money. Now, a couple of things triggered me on that. Number one, I'm going, $20,000 in a Prince funeral. I don't know that $20,000 would pay for his boots and his suit. So I'm thinking, gosh, how terrible does Prince feel right now that all he got was a $20,000 funeral? But then I sort of realized, like, this happens every day in America. Somebody passes away. One of the family members is typically deemed more successful by the other family members. You know, if you're listening to this, you may have been the one that had to pay for an uncle or brother or sister or parent's funeral. One of the siblings is deemed more successful. They get stuck paying the bills. They never get reimbursed. And now Thanksgiving's awkward.
Absolutely.
And what broke my heart and why I'm so passionate about this is the majority of the time, there was money there that mom or dad thought the family would be able to access. They just didn't know. They didn't know it wouldn't be available when the family needed it. And so that's what we solved with the Beneficiary Liquidity Plan.
The Beneficiary Liquidity Plan. So basically, it's about immediate liquidity, which a lot of people might assume it doesn't take that long to get the money. If we die, your kids just go to the bank and go get it. So what's the normal process for someone when they die? What do the beneficiaries do? How do they get the money?
So I always ask people, I'm like, you know, if you died tomorrow, how would your family solve the liquidity problem? I just like, what do people think? And there's about 8 things people typically say, and we kind of walk through them, and the banks freeze. The banks freak out. If they know somebody died, they lock down everything. You can't get into the safety deposit box without a death certificate and a will. You can't access the accounts. We can have a whole separate podcast on joint accounts with your kids and why not to or to have that and the difficulties with that. But I love life insurance. I love annuities. That's what I did for 20 years. But they require a death certificate. Now, one benefit of Missouri and Kansas is they're 2 of the faster states, but it still takes a couple weeks minimum.
A couple weeks. So someone dies, you have to request before anyone can get any money from somewhere. It requires a death certificate, stamped,
certified death certificate,
and that normally takes 2 weeks.
Minimum
2 weeks,
and that's assuming known cause of death.
So. All right, that's a good point. But then, so if somebody does have a joint account, that might be a situation where they could get the money sooner, potentially, or no.
This is the interesting part. So people say, well, I have a joint account. I'm like, well, is it joint signer? Which does not work. And if it's joint owner, is it joint and
Right.
or joint or.
Okay.
And I don't like to
Right.
pick on the banks, but I'm like, okay, when the 25-year-old bank teller set up that account, do they understand estate planning and how to title things
Right.
properly?
I gotcha. So there's still a chance that may not work.
And
either.
what if there's no money in the account?
Right.
And again, we can get into
Yeah.
what happens, especially with couples when they have
Right.
joint accounts. But
Absolutely.
so life insurance annuities, take a death certificate.
Yep.
People say, well, Phil, I went down to the bank and I titled all of my non-beneficiary accounts, and this is true on the investment side too.
Yep.
POD or TOD.
Yep.
Payable on death or transfer on death.
Yep.
Which I highly recommend.
Right.
That avoids probate.
Yes.
But what piece of paper do you need to take to that financial institution to transfer that money on death?
Still need the death certificate.
You need a death certificate. People say, well, Phil, my son's the executor and he's financial power of attorney, which I think, again, super important in an estate planning.
Yeah.
But unfortunately, the power of attorney dies when you die and it doesn't work post-death.
Yeah.
Then we get a little bit deeper. Well, Phil, we got our full estate plan. We have a living trust or revocable trust, which I think is an amazing way to make sure your assets pass the way you want, protect them. And they say, well, Johnny, who is my financial power of attorney, is also the successor trustee. That's smart. What piece of paper does Johnny need to take to the attorney to start the process of becoming the successor trustee to access his accounts? A death certificate. You see a trend here, right?
Right. Yeah, exactly.
And so everything requires
A death
certificate.
Yes.
But here's my favorite part. Here's the good news. We were talking about this morning.
Right.
It doesn't cost anything to fix the problem.
Okay.
Again, I smile every morning because I'm like, it doesn't cost anything.
If it doesn't cost anything, then why not? I know we were talking about this a little earlier. Then why not?
Right.
Why wouldn't you? If that's a potential issue that could be resolved. Kids need immediate liquidity. They can't get the death certificate soon enough. We still have to buy all the funeral arrangements, all the burial costs, all that kind of stuff. And where are they going to get the money from?
My job is to help people determine what's the minimum dollar amount we think their family's going to need. Out of all the inheritance, where do we want to allocate it from? And then it's simply a reallocation of whatever that dollar amount is into the beneficiary liquidity plan. And our secret sauce is that we don't require a death certificate to pay out immediately at death.
So it was funny because, Paul, we were talking earlier before the podcast even started about the situation in Chicago where somehow or another the coroner himself, age 50-ish years of age, passes away, dies. He's the one who signs all the death certificates. He's not there. And so now there's this backlog of death certificates that need to be
Nobody can do anything.
Signed off on, and nobody else can do it. So now people are waiting 6 months before they even get this certificate to be able to go and get all the money out of these institutions.
The stories I could tell, we're writing a book called America's Beneficiary Liquidity Crisis, and it's real stories from real clients on what happened when family members passed away. We had a married couple in New Jersey, and I know we're not in New Jersey, but they were both 84 years old. Husband passed away. Well, New Jersey has a state estate tax.
Right.
The bank froze the 84-year-old widow's joint bank account because they wanted a New Jersey state estate tax form signed off with a death certificate before they would release their funds.
Right.
Like
amazing.
The stories are just remarkable, and it comes back to I can't sit here and tell you that you can't figure it out.
Right.
Paul, we were joking about I don't know if we're joking about it, but we were talking this morning. Like, for generations, there wasn't a solution.
Yep.
And we're all still here.
Yeah.
We figured it out.
But
my definition of figuring it out, when you leave it to your family to figure it out, means it's going to cause stress, arguments, disagreements, family fractures. People's brains go mush when somebody dies.
Right, absolutely.
And it's already stressful.
Yeah.
We've seen, kids sneak into mom's house and steal the silverware during the wake. It's like, I want that rug. Like, let's not put money on top of that issue when it's already there.
It's already there. And I think that's the crucial issue here, which is what I really appreciate. You know, we encourage our clients like you do. You said, get the power of his attorney, get the trust set up, get all these things. Those are all good. But it doesn't solve the immediate liquidity issue. And some people might think, well, I've already done all those things. And so it is important for people to say, if I want to finish the job, in other words, if I want to make sure that I've got a plan for everything, this is one of what happens when we die. How do our kids or our family get the money to upfront pay all the costs that are up front,
right?
The burial, the funeral costs, all that kind of stuff. So how much money do we want to set aside? So I guess the planning process is more, how much money do you think this is going to take? And maybe we can talk about that for a minute.
Absolutely.
I don't know if there's a rule of thumb or how someone can find it out. What is it per person? Let's set that money aside. And then when you say set it aside, I definitely want to talk more about what that means. How do they get this? Without just saying, I'm going to put this in just a separate savings account. So we can talk more about that. So as far as, and I guess one question on the top of my mind is this really thinking about a second to die situation? In other words, if there's a spouse, is it really about, I guess we don't know which one's going to die first. You have it ready for both of them. I guess I answered my question, but
again, when you talk about dying all the time, that's all we do. We make a lot of jokes.
Yes.
And, I've told a husband and wife, I'm like, well, just tell me who's going to die first,
right?
Yeah. And we'll write it on the second one. But what we realize is we end up doing a solution for both.
Okay.
Making each one the primary beneficiary, then making their executor the contingent.
Okay.
Because unfortunately, we've seen people die at the same time or close together. Accidents happen.
Yeah.
Or, unfortunately, most people don't just go to sleep and not wake up.
Right.
Right? Like, I don't know if that would be better or worse, but like normally we're in and out of the hospital.
Yeah.
Maybe some home health care.
Right.
Heaven forbid assisted living or nursing home. But that's kind of the trend, the process for dying is you don't just go to bed and not wake up. Mm-hmm. Well, what we see with a lot of husband and wives is that the husband is sick. The wife's trying to help take care of him. Mm-hmm. There's expenses above what Medicare will cover and normal insurances. So that joint account's getting slowly depleted.
Yeah.
She's not thinking about that. She's thinking about her husband.
Yeah.
He dies. Now there's not enough money in that account for her to pay the normal bills and cover the funeral expenses. And then it's like, okay, well, where do I go get more money? Well, do I want to pull it out of the stock market? Maybe it's not a good time to do that. Mm-hmm. What if it was just already there?
Yeah.
And again, it comes back to it's just reallocation of assets you already have. You're not buying a bigger net worth. You're not buying a bigger estate. You're not buying more inheritance. It's just reallocating some of that money so that when you die, one of the worst days of your family's life, the day you pass away, we at least eliminate the immediate financial burden by giving them access to money they were ultimately going to inherit anyways.
Right.
Yes.
I gotcha.
That's the key.
So when someone's looking at funeral expenses, these sort of costs, is there a standard or is there a rule of thumb? Do you go to the funeral home and get an estimate of the area that you're in, or what's a general rule of thumb that you say, hey, per person, I would set aside $25,000 per person. I would set aside,
Yeah, I mean, it's really preference of do you want the Cadillac casket or do you want an inexpensive cremation and a family gathering? What's been interesting about the baby boomer trend is it's transitioned a lot from the traditional side to more of a celebration of life. And so it's like, what do you want that to look like? We found when we survey people, almost 100% of people, if we ask them, do you want your family to access money for your funeral expenses, it's almost 100% yes. Mm-hmm. And then if we ask them, have you prepaid for your funeral? Yeah. I already know the statistics. It's about 8% of people die with a prepaid funeral.
Okay. Right.
And I always go, well, why is that? Well, I don't really want to go to the funeral home and pick out my casket. Right. Mm-hmm. But everybody knows they don't want it to be a burden, but they don't want to actually go pick it out. So what's great about our solution is they can use it with any funeral home, at any state.
Yeah.
Okay.
It's not assigned to like, well, I got to go to Bob Jones' funeral home. It's a good point. It gives them some flexibility.
Any state, any funeral home. So our philosophy here has always been don't prepay. Because if you go to one funeral home, they may be out of business, or don't prepay, pre-planned. So you're not against pre-plan. Go there, find out.
100%
Hey,
pre-plan.
if you want to go pick out all your stuff and you know what the cost is, great. Pre-plan. That's what we always tell our clients. You don't have to pay for it, but at least get that work done. That's a gift you can give your beneficiaries, so they don't have to go in there and make all those
What
kinds
would
of
mom
decisions.
want? You know,
I
it's
know.
like-
The last thing you want to do is be cheap all of a sudden with your
And then you and your
mom's cash.
sister are arguing over,
Absolutely.
well, mom liked the dark wood. No, she
Oh,
wanted.
exactly. So if the parents can go take care of that, I always say that's a great gift. Pre-plan it, don't prepay it, but at least they can go there and say, I've already picked it out. And then if you could add on to that, not only did we pre-plan, everything's already picked out, we already have the money available.
Correct.
So let's get into that. You said several times now, it's about reallocating assets.
Right.
So what does that look like? Someone wants to set aside $50,000 immediate liquidity for my kids. Yeah, they're going to inherit $500,000, but I want them day one to get $50,000 the day after I die. What does that look like? What are we talking about reallocation?
So we would typically allocate $50,000.
Okay.
And it's going to grow tax deferred,
Okay.
which I love.
Yep.
And it's going to pass tax free.
Okay.
And right now it's growing at 3.35%,
Okay.
which I know that that's not the
Right.
highest rate.
Right.
But if you remember, I said we want to put the minimum in.
Yeah.
Just like a checking account pays less interest than an annuity,
Mm-hmm.
it's because you can take all your money out of the checking account. Liquidity has a price.
Yeah.
Yes, it does.
And the price is rate of return.
Yeah.
So we want to balance that and not overfund the beneficiary liquidity plan unnecessarily,
Okay.
because we could keep that money allocated to other vehicles that
Okay.
you have that can generate a higher rate of return.
So is that rate something that's variable, or once you're in it, that's your rate for that period of time, or does that fluctuate once you're in? Or
It can change annually.
okay.
The company we built the product with is a mutual insurance company
Okay.
that puts
good.
policyholders first. We actually had a rate increase this year.
Okay.
They went backwards and raised everybody's rate.
Okay. Good.
I mean
Awesome. Yeah.
that's something I had not
Yeah.
seen in 25
Yeah.
years, was to go backwards and raise,
Okay.
Wow.
make people's rates
So
better.
this is not a life insurance policy. Is there underwriting, health underwriting, or anything like that when you buy this?
So the chassis, and we can get into the weeds
Yes.
a little bit. The
Yeah.
chassis is a guaranteed issue,
Okay.
single premium, fixed, whole life insurance contract with a 119-year-old A-rated mutual insurance company.
Okay.
Now, everybody hears life insurance. Just
Yes.
like, we've all been doing this a long time. I think, like, you put in pennies, you get back dollars.
Right.
That's not what this is. This looks more like a savings account
Okay.
or a CD, but at an insurance company instead of a bank.
Right. Okay.
But the secret sauce is we don't require a death certificate to pay out that tax-free benefit to the beneficiaries. And by the way, we've been doing this. Last year, we paid 68,000 claims
Whoa.
without a death certificate.
Amazing. Okay.
Wow.
Just last year.
Yeah.
And the year before that was like 67,000 claims. So this isn't something that is
Okay.
new per se.
Okay.
We're doing it on high scale.
Okay. So Joe and Jane client, they go in there, they say, I want to put $25,000 in here. I'm going to reallocate. I'm going to take it from the bank. I'm going to take it from a non-qualified account. I'm going to purchase this thing. When they purchase it, is it illiquid? In other words, is the only way to get that money back then at death? It's the whole point of this is a death benefit. The whole point of it is a beneficiary liquidity plan. It's nothing like, hey, never mind, I want to take the money back next year. It's kind of like this is set aside for death.
Yes and no. So I
Yeah.
built it to where this would not be the first money you'd go to if you needed money.
Right.
Yep.
Yeah.
Because we'd have, again, we've
Yes.
been doing this 6 years. We had a lot of these conversations where people go, what if I need it?
Right.
I'm like, well, you can't spend it
Right.
and your family use it no matter where you
Right.
put it.
It's not an
It
extra
defeats the
savings
purpose.
account. Exactly.
Then I go, well, if you think you're going to need it,
Don't.
maybe we're talking about too much money. Maybe we need to lower it a little
That's
bit.
right.
And if somebody did,
Yeah.
for whatever reason,
Worst case.
there's a loan provision that they could borrow it.
Yep.
We don't advertise that because, again, that's not what
not
it's
the
for.
point.
Yeah.
And they can get 70 to 80 cents on the dollar
Okay.
if they
Yep.
if they just said, just give me my money back.
Yep.
Well, we've invested it for the long term. There's a penalty for
Yep.
that.
I gotcha.
And
Okay.
again, we want to deter people from using this money.
That's right. The point is, it's for the kids. It's for liquidity. That's where I get it. And then when you say reallocate it, just you write a check to it. And is it just non-qualified funds, or can it be qualified money too?
We've actually seen an influx of qualified money coming out with the taxes going up.
Okay,
in 2025.
Yep.
Taking free withdrawals from IRA annuities.
Okay.
Paying the tax today.
Yes, I gotcha.
Because we know what it is.
Yep.
Now getting it in tax deferred and it's tax free for your family, for your heirs, with the added benefit of they get immediate access without a death certificate.
So 3.35 tax deferred and being tax free. So the internal, is higher. That's great. And so, but again, what's the process of opening the account? Is there underwriting? Is there health questions?
Great question.
Is there health underwriting?
The only kick out is you can't be 91. Okay. That's it. And you have to care about your family.
It is 90 and below.
90 and below.
90 and below. Okay.
So you have
to care about your family.
And you have to have some sort of assets to allocate. So because we don't create wealth.
Right. Yeah.
We help create the inheritance you're already leaving, make it liquid.
So Joe client opens an account. He moves $25,000 into this account. The only question they're going to ask is, do you care about your family? And are you 90 years old or less?
Yep.
They do it. They get a policy.
Yes.
And then this policy has beneficiaries listed.
Yes.
Right. So Joe client dies. What do the beneficiaries do? How do they get this money?
Great question. In this country, whether you're being buried or cremated, you end up in front of a licensed funeral director. That you're going to end up in a funeral home.
Mm-hmm. Yep.
Whether you're being buried or cremated, the hospital gets the call that they're going to say, "Hey, what funeral home they going to?" Mm-hmm. And you end up in front of a licensed funeral director. Yeah. And this is part of our patent: is the funeral director goes, "Yep, Phil's dead." Mm-hmm. That we did that 68,000 times just last year.
Yeah.
Our relationship with all the funeral homes in the country, they tell us you died. Mm-hmm. That is our proof of death.
That's it. You're not waiting for a death certificate to come in the mail 2 weeks later, a coroner to sign off on it. The funeral home says Phil's here.
They sign off on the claim form. They say, "Yep, Phil's dead." And what we do to make this even easier, the funeral home's going to send us, the insurance company, a bill for what your family picked out.
Okay.
That your family signed off on.
Gotcha.
We're going to pay the funeral home for the family.
Okay.
They don't need to worry about the bill. Boom. Immediately paid for.
Okay.
ACH direct to the funeral home.
Yep.
The excess money is immediately deposited to the beneficiaries. So let's use the $25,000 example. Mm-hmm. The average funeral plus other cemetery expenses and things, according to the National Funeral Directors Association, is about $15,000.
Okay.
And it varies, but let's say $15,000. We would pay that bill to the funeral home. Mm-hmm. Done. Family doesn't need to worry about it. Go celebrate mom.
Yep.
The additional $10,000 is immediately direct deposited to the named beneficiary or beneficiaries.
Okay.
And they can now use that money to fly in their sister from California, to book the trip, to pay bills, whatever it may be. I recommend that you make your executor the primary beneficiary.
Okay.
Because
not like multiple beneficiaries.
That's what the other assets is for.
Yeah.
Who's responsible for paying
everybody
everything?
there.
And who's responsible for the bills? And I'm gonna talk later about what it takes to settle an estate.
Okay.
And what that responsibility is for the executor. Most people don't realize how difficult that is. Let's not make it difficult financially as well. So if we put more money in, sometimes we'll do multiple beneficiaries. But for the most part, I'm like, the other inheritance is for the rest of the family. This is for the executor or your spouse to take care of everything.
To get everybody there. And so it's interesting you say that. So the funeral home directors also have an incentive to sign this thing, get it turned back in, because they know they're going to get paid right away from you guys.
They love us. Think about if somebody prepaid for a funeral 20 years ago, and they're locking in the price and inflation. That's tough business for some of the funeral homes today. Whereas your family's showing up, and what funeral homes want is a great family experience. They want repeat business because it was a good experience. And what's not a good experience is when you have all the siblings staring at their shoes with their hands in their pocket going, "Who's paying the bill?"
That's right.
And I have some interviews with funeral directors and some with estate planning attorneys, and one of the funeral directors, he's like, "We have a sign that says payment is due when services are rendered."
Right.
People like to say, well, Phil, they'll give us 60 days. Yeah, they got bills too. And once they perform the service, well, what's their recourse?
Oh, I know.
If they cremated you,
right? They don't want to. The funeral homes aren't in the collections business. That's for sure.
And there's so much consolidation through big private equity in the funeral space where it might still say Bob Jones Funeral Home. Mm-hmm. Bob Jones might still work there, but he's part of a larger.
That's right. He wished he could help.
Publicly traded entity that just says, "No, we need payment."
Okay. Well, very interesting. So it meets the need for immediate liquidity. It doesn't cost anybody anymore, which is what your point is. Even if they could access money they already have sooner, why take that chance? Set this money aside. It's one extra step to say, we have a beneficiary liquidity plan. Here's the policy. Take this to the funeral home, have them sign off on it. You guys will have the money you need. Just talk to the executor, make sure he or she gets everybody here. And then later, after the dust settles, then 2 weeks later, 3 weeks later, the death certificate comes in. That's when you go deal with all the IRAs and the 401ks and all the other stuff. But at least up front, this just handles the money issue up front. And so you have seen, Paul, he's seen over the years, it's those first couple weeks where all of a sudden it's the stress of someone dying, but also the stress of who's paying for all this. And we got to think about that for those first couple of weeks. It's hard enough. And so this eliminates that issue, which is why we love certain product innovations, because it meets a need.
Absolutely.
And this is certainly one of them.
Yeah. And, I think some people may say, well, how can this be true? Well, I can tell you, the government doesn't need a death certificate to classify that you're dead. Social Security stops immediately.
Yeah, they don't wait.
So like you were talking about in the joint account, not only have they depleted the account because of all these expenses, but now they don't have the normal income coming in, because the minute you die, Social Security stops.
And pensions do the same thing.
Do the same thing. So your income stops too. So there's an extra need there. But but obviously they figured it out.
Yep.
That they don't have to have a certificate to show that you died.
Yep.
And so it's great that you've been able to figure out a way to make this happen.
Yep.
And I love the fact that it's as simple as, yes, it's validation, not just from someone just calling up to say. So you're not going to get the person who dies on the internet 10 times, like some of these celebrities who have died over and over and over again on the internet, It actually takes a funeral
because the funeral director literally is looking at you, and that's the verification.
Yeah. So we answer the question why. It gets people. We also answer why not then. Why not? If you have the cash to do it, set it aside. They can get to it. It's done. It's just something else. Again, we always talk about financial peace comes from having a plan. And one of those things, peace of mind, is hey, I know if something happens to me suddenly, my kids are going to have this money. They're going to be able to be taken care of. They have enough money for the future, but also just these first couple weeks. That's what we love about it. The Beneficiary Liquidity Plan. What does the application process look like? Is it a 1-page or a 2-page? How simple is this?
Yeah. So it's all electronic.
All electronic.
Name, address, social security number, date of birth, who's your beneficiary.
Yeah. And so, Paul, obviously, Wise Wealth, our firm, is ready and able to help anybody. So anyone who listened to the podcast today, whether you're a client of Wise Wealth or not, this is certainly something that we can help people with. You don't have to even be a client of Wise Wealth for us to help people with the Beneficiary Liquidity Plan. There's certain advisors around the country that are licensed with Phil, with his team, with the Beneficiary Liquidity Plan. And so we're one of them. And so anybody that wants help with this certainly can call us. And I know you'll give them the information on how to get a hold of us here.
Yeah, absolutely. And, it's great because it fits in both with estate planning, but also insurance planning. Yeah. And so even when we look at the 7 areas of planning that we address here at Wise Wealth, it kind of falls in several of these
and
areas.
Tax, right?
And tax planning and insurance planning and estate planning. And so it is one of those things that, again, it solves a need. And so if your plan is in place, the last thing you want to do is do all the work to plan. And then add extra stress when you could have simply avoided it.
We call it, we trademark the final piece to the financial plan.
Okay,
This is that final little piece. You got everything else set up.
Yeah.
This is that final little piece. Just to kind of bridge that gap for that first 45, 60, 90 days while your estate's being settled.
So it's the final piece that gives you the final piece.
Correct.
Yeah.
The final piece of the financial plan.
Yes.
I like that, man. We like trademarks around here. Yeah. So anything that we have a lot of trademarks that we've gotten over the years. Exactly. That's a good one. So that one's yours. So thanks, Phil, for being here. Appreciate you being on the podcast
Thank
today.
You guys.
So,
Absolutely. And so appreciate you being here, Phil, and Stephen, bringing Phil in. You know, it's always great to have different guests on, but again, to have something unique like this, to be able to address that, to have that final piece for the financial plan. And so, you know, for anyone watching or listening that is interested in this, certainly you can give us a call at our office at 816-246-9473. That's 816-246-WISE. Or you can email us at info@wisewealth.com. Also, when you're calling or emailing us, ask for a copy of Stephen's book, Simplify Retirement, just re-released. And so the newest copy is out there, Timeless Principles. And so, you know, products come, products change, products innovate, which is great. But the planning principles don't change. And so if you're looking for that financial piece that comes from having that plan, give us a call and we'll talk about the next steps. It starts with simply a conversation. So again, Phil, thank you for being here today.
Yes.
Thank you, Stephen, for the investment in knowledge for our clients and for all our listening audience. And again, our last thank you goes to you, the listening, viewing audience. You're the reason we do this. Without you, we wouldn't be here. So from all of us at Wise Wealth, Simplify Your Retirement, this is Paul Brox reminding you that financial peace does come with having a plan. And we'll see you next time.